What's going on, everyone? This is Lior and welcome back to my channel. Now in this video, I'm going to talk about the 3 most common ways you can personally invest into other people's real estate deals as a private investor, right? Because you might have probably done some research to this point and know that you can invest into other people's real estate deals, whether it's a construction project or a rental project, but you can essentially find someone, write them a check, and be passively invested. So I'm gonna give you guys the 3 most common ways I see people funding these kinds of investments. So with that, let's get at it. What's going on, guys? My name's Lior and welcome back to my channel. Now, before I get into the meat and potatoes of this video, super quickly, if this is your first time on my channel, make sure you smash that subscribe button. I put out tons of new videos every single week talking everything about rental property investing, finances as it has to deal with rental properties, behind the scenes access to my projects, and so much more. So this is your first time, just give me a subscribe. So with that, let's get right into it. And as I said, I'm gonna give you guys the 3 most common ways I see people investing as private investors into other people's real estate projects. Now, I've seen all of these 3 methods done from private investors that have invested in my own deals and from other operators that I know as well. So these are definitely the most common. We're gonna start with number 1, which is probably the most obvious, and that is cash. And with cash, there's probably a few different ways you might have that sort of cash lying around. It could be from a big event, one big influx event, such as an inheritance, or maybe you got a big bonus in your job, or maybe you're just a high income earner and you've been working for a long time, been diligently saving, and you have a pool of money that you've saved up that you would like to invest in passively, right? Now, again, the big advantage of investing passively is you yourself don't have to do any of the work. You don't have to do the construction work, the stabilization work, none of the management, acquisition, finding the deals, financing, right? You literally just stroke a check and you can invest directly into a real estate project. Now, investing in cash is relatively straightforward, right? Regardless of how you got it, you're gonna take that cash, write a check, and invest it into someone else's deal. Now, the one thing I will talk about with cash, of course, is the tax consequences with investing in cash. Now, you might be pretty familiar with tax structures, but I'll give you guys a couple of buckets. So, of course, your most common tax bucket is the taxes on your ordinary income. Then you also have taxes on other buckets, including, and I'll give you guys a list, taxes for passive income from handoff investments. You have taxes on interest you received on money that you lent to someone or in a savings account in a bank. And then you have, also, of course, capital gains taxes, which could be short-term capital gains versus long-term capital gains. In short-term capital gains, that's for projects that last under a year. Long-term capital gains are for projects that last over a year. Now, what's important for you to know, especially if you're going to invest into someone else's real estate project, is that both interest income, right? So let's say you lent money to a real estate investor who's going to pay you a certain percent fixed interest rate on your money, or short-term capital gains are both taxed as ordinary income, whereas long-term capital gains are taxed at a lower rate. So depending on the structure you invest in, whether you're lending a real estate investor money, again, as debt, where you're gonna get a fixed interest rate, or you're gonna invest into a project and be a part owner, right? Depending on whether it's gonna be a short-term project versus a long-term project, you want to understand the tax consequences of your investment. So I always recommend for anyone that's thinking about making such a move to talk to their CPA so they can understand exactly what their liabilities are going to be on the taxes, as well as when you make your actual profit, right? Whether it's interest or a large chunk of capital gains, you can set aside an appropriate amount to pay those taxes at the end of the year. Now, I know I just kind of talked about taxes, but before we go into the second most common method, I do need to talk about one of the big tax advantages of investing in a long-term rental property, whether you're gonna do it passively or actively, and that is depreciation. I'm not gonna jump into the weeds of it, but basically, if you invest into a longer-term rental project, one of the big tax benefits you'll also experience is this concept of depreciation, where essentially a real estate investor can write off a loss on their income for part of their property every single year, right? So just for easy numbers, let's say a property generates $10,000 of cash flow every year, right? So on the taxes, it'll say $10,000 of cash flow. But what you can do with depreciation is, let's say you can depreciate $6,000, for example, per year on of the real estate, right? So what will act on your taxes, what you'll actually be liable for is not that $10,000 of cash flow, but that $10,000 minus that $6,000 of depreciation, which is actually $4,000, right? So even though in reality the property made $10,000 and as a private investor, you might have gotten a chunk of this, your tax liability is actually going to be based on a much lower number because of that depreciation. And if you've read anything about maybe even Donald Trump or other big, large real estate investors, you know that a lot of them are able to structure it in a way where they actually take losses on their taxes. Well, this is one of those methods. You can actually create positive cash flow, but on your taxes, you can actually create a loss. So it looks like you're losing money, which is another huge tax benefit of investing passively or of course actively in real estate. Now let's go into method number 2, which I see very often in investing passively in other people's deals. And that is by tapping the equity in your home or other real estate. And there's two primary ways to do this. There is you can do a cash out refinance, where you cash out, get a check, and use that funds to invest in the deal. Or you can take what's called a home equity line of credit or a Heloc and use that line of credit to invest in other people's deals. Now, let me get a little bit into the advantages and disadvantages of each method. With a cash out refinance, basically, if you're not super familiar with the concept, you're going to get put on a brand new loan on your house, right? Let's say you've got $1 million, you live in $1 million home, and let's say you currently only owe $500,000 on it. Well, you can go do a cash out refinance of 75% of the value, right? Which would be 75% of $1 million or seven, and basically take a new $750,000 mortgage and place that on your home. Now, what's going to happen is when you do that, your previous mortgage was only $500,000, so you're going to cash out $250,000, which could be funds that you can use to invest in other people's projects. Now, the big advantage of that is with a cash out refinance, again, it's a brand new mortgage, which typically means you're getting a fixed interest rate, and it's typically a rate that is spread over 30 years, right? Amortized on a 30-year basis. So you know exactly what your payments are going to be for the duration of the mortgage. So the advantage of that is, again, this is a long-term debt you just took on through that new mortgage. So if you want to invest in projects that have longer time horizons, right? Maybe like a real estate rental play where you're going to invest into someone's rental property and they're going to, sit on it for 3 to 7 years. That could be a fantastic play, right? Because you don't have to worry about any interest rate fluctuations on your end. You've got a fixed interest rate and you know exactly what your payments are going to be for the future, and you can see exactly where your payments are going to be from your investment into the real estate project. So it makes for a nice long-term play. However, if you don't know exactly where you want to invest these proceeds, right? Let's say you've been thinking about investing passively, but you're not 100% sure into which project you want to invest to, or maybe you kind of want some shorter duration stuff where you only maybe you only lend money for 6 to 12 months. This is maybe not the best move for you, because once you close on that new mortgage, you're starting to pay those payments right away, right? I mean, you are ready from day one. As soon as you do that cash out, you're going to start incurring a new higher mortgage, right? Because your old mortgage in that example I gave you guys used to be $500,000. Now your new mortgage is $750,000. So you already have a much higher cost of mortgage from day one, right? So if you don't place those funds right away, technically you're just going to incur higher debt payment without having a return on those proceeds you cashed out. Plus, if you're only going to invest in shorter term stuff like that 6 to 12 months, well, it's great that you do that, right? And let's say you generate a return for 6 to 12 months, but once you get that capital returned to you in 6 months or 12 months or whatever it is, then again, you're kind of going to have a stagnate period where that capital is not working for you per se, and you're again paying a higher mortgage payment. So it might not necessarily be the optimal way of structuring it. Now let's talk about actually doing this through a home equity line of credit, or as I say, a Heloc. With a Heloc, when you do a Heloc, which I've done on some of my own properties, typically it's an interest only payment with a floating rate, right? It's certainly not a 30-year fix like a typical mortgage. you have a lot more variance in your interest rate when you do a home equity line of credit, right? So in that same example where you have $1 million house, you have a $500,000 mortgage, you can essentially apply and open a line of credit for up to $250,000, which you can draw on as you need, right? So it's not like you pay on that $250,000 from day one. Typically, you only pay on what you draw. So let's say you want to make a $50,000 investment here. You're going to pull out $50,000 from that line of credit and only pay that interest on that $50,000 that you borrow. So as you can see, this is probably a better way to structure things if you're going to do short-term loans to real estate investors of 6 to 12 months, right? Because again, you can take quick draws, lend them to investors at 6 to 12 months. You're not taking a lot of interest rate risk, right? There's not a huge risk of the interest rates completely getting jacked up within 6 months. So the variant interest rate on your home equity line of credit is not as big of a factor. And then once you lend the money back and you get it paid back in full, let's say a year later, you can pay off that principal that's out on the home equity line of credit and not be charged additional interest while you're waiting for the next opportunity. So that's why this could be a really good strategy if you're looking for short-term investments. If you're going to be looking for a longer-term investment, there are some risks, and which are mainly the interest rate risk, because let's say you want to make a play for 5 years on a rental property. That's great, but over the course of 5 years, there's obviously a higher probability of your interest rate on the home equity line of credit adjusting and potentially screwing up your calculations. Regardless of which method you choose though, whether you do the cash out refinance or the home equity line of credit, I think tapping into equity is one of the best moves, right, for someone looking to invest passively. Again, I've done that myself where I've taken home equity lines of credit to invest in real estate. I think, because typically when you have a primary residence, especially if you have a lot of equity, that equity is not really working for you. So this is a great way to put your equity to work and make a return on that money. And the third most common method of people investing in passively in real estate deals is through self-directed IRAs. And I've had quite a bit of investors use this method to invest in my own deals. I know a lot of people really like these. So I'll kind of give you guys the overview of what that means. So if you don't know, a self-directed IRA essentially is a retirement account that's owned and controlled by a person and not necessarily a company. So the funds are actually held in an account by a third party called a custodian. And if you have a self-directed IRA, you can essentially direct those funds, right, self-directed, to be used in in a number of different investments. You can of course invest in things like stocks and bonds. You can also invest in partnerships, in precious metals. You can lend out the funds as a loan to other people, right? So again, if you want to structure your passive investment as debt, that's a great opportunity. And you can of course invest directly in real estate as well. But the key thing to understand with a self-directed IRA is, even though you can certainly do that, right? Let's say you decide to invest in real estate, passively invest in real estate using that. One of the things you need to understand is you cannot invest in your own projects, right? So I could not, for example, take my own self-directed IRA and invest in my own project, because basically the rule is you cannot benefit from that. You cannot personally benefit from that investment made by the IRA, right? It's only the IRA that can benefit. So hence, you could not take those IRA funds and invest into a piece of property that you are also going to own. And it's the same thing for your descendants and ascendants as well, right? So you couldn't take that and put it into a family project or anything like that. It needs to be completely separate. Now, you might not be super familiar with the concept of self-directed IRA. You obviously probably have heard of the 401k, and those things are not the same. 401ks, just so you have that context, are retirement accounts that are typically set up by companies for their own employees. Now, what will happen though is if you do leave a company, that 401k will convert to a IRA, right? But not a self-directed IRA. You will have to do that yourself. And the difference with a regular IRA is those retirement accounts are typically controlled by financial strategists or planners. And what you have to understand is, if you go to let's say you have an IRA and you have a financial planner or strategist or whatever, and you tell them you want to invest passively in precious metals, some partnerships, or real estate, you have to understand that you might get some pushback from them, because basically by converting an IRA to a self-directed IRA, you're essentially taking that person out, right? You're taking that advisor's role or financial planner's role out of the equation. So for them, there's obviously less interest in you making this transition, right? Because you're essentially cutting them out of their role. So just be aware that if you have a IRA currently and you are trying to or have been trying to convert it to a self-directed IRA, if you talk to your financial planner about it, there might not necessarily be 100% aligned interest. Just something to think about if you're going to go through that process. But the concepts are the same. You can take those funds, if you do get a self-directed IRA opened up, you can take those funds and invest them into other people's real estate projects. Again, you can use them as loans to real estate investors, or you can passively invest and make your IRA one of the owners in that real estate deal. Now, one of the other cool advantages of investing in a self-directed IRA, there is a nice tax advantage. You do not need to pay taxes on the annual income generated from the investment. So unlike if you were gonna invest in cash and loan that to an investor, right, and you're gonna generate some interest income out of that, you would be liable for taxes. But if you're doing it through a self-directed IRA, you're actually not liable for that. The only time you're gonna have to pay taxes on that is when you actually use those funds in your retirement and actually draw on them for personal use. But the advantage of that is you can essentially keep rolling the profits tax-free over and over again, right, without needing to pay taxes today. And that allows you for additional compound growth on your investment, which is obviously huge and a fantastic tool for your own personal wealth. So that's the overview on the 3 most common types of methods I see people using to invest passively in real estate deals and projects. If you guys have obviously any questions, any comments, make sure you shoot them below and I will definitely help you out.